3, 2, 1, 0.
What's up, guys? In this video, we're going to talk about the REI spectrum. So REI, when I was first starting, I didn't even know what that meant, but REI stands for real estate investment, right? So real estate investment spectrum. And to kick that off, we're going to talk about all of the different types of real estate investing. This is very important. If you don't know these things and you're talking to someone else, you're going to look foolish. But also, it very much can play to your benefit, because when you see a piece of property, you know exactly what exits you could take on it to make money, right? If you know all of the different ways you can invest in that piece of property. So we're going to talk about that. We're going to talk about the pros and cons of each, right? Each of them have their advantages and disadvantages, despite wholesale, which we'll talk about as well. And then we're going to finish up with investment Foursquare and then the cash business path. Starting from $0, how do you build up a large base of cash and assets in real estate, right? So that's what we're going to end with. So let's talk about the different types of real estate investing. We've got a few on the board, right? So we'll try and dive through these as quickly, but without taking away from the items, the knowledge that you guys really need in order to excel in real estate. So at the top, we've got slow to money, right, stuff. So buy and hold, that's owning a rental. That's going to be slow to making money, right? You're not going to make a bunch of money fast. Whereas down at this side, we have micro flipping. We're co-wholesaling, wholesaling, and micro flipping, which are all very quick ways to make money, right? So depending on what your plan is, if you're looking to build really long-term wealth, if you have a lot of money right now, or if you're just getting started and you have no money, you're going to choose probably a different place on the spectrum to start in real estate investing. My personal favorite happens to be down here, right? Right in the wholesaling, co-wholesaling, and micro flipping area. But yes, so buy and hold. Really, the pros of buy and hold are you get consistent dividends, right, in the form of rent checks, right? So if you put 100 grand in and you're getting $800 each month, that's like a dividend on the 100 grand that you bought the property with, right? With that, if you leverage the property as well, then you increase your cash on cash return, which can be a great way to build a portfolio and build income for yourself and have passive income, which is very nice. It requires some dollars, and then you also have market exposure, right? So those are more the cons. The market exposure part, if you buy now for 100 grand and next month it's worth 80, you take that $20,000 hit, right? If you needed to sell, you would lose 20 grand. Ideally, if you're buying a buy and hold, you hold onto that property and you don't sell till the appreciation has returned. With that, you also have depreciation benefits, right? Which are benefits on the tax side of the equation. So if you own a lot of rentals, you can depreciate them and save money on your taxes. So consistent paychecks, right? Which is very nice. Passive income is always good. And then saving money on your taxes. And then the third one is appreciation, right? For a benefit. So as the market goes up, your property is also appreciating. So it's a good store of wealth. And historically, real estate increases in value just like the stock market. Whereas cash, right, if you just have cash sitting in your bank account, it won't keep up with inflation. So technically, you're going to be losing, at least right now, you're going to be losing between 2 and 3% of your money each year if you just hold it in cash. But if you have it in an asset, it will at least appreciate that much, which is really nice. That's a good thing. So the second thing here, which is still slow to money, right, but not bad, is seller financing, subject to financing, creative financing. Now, you can pair this with wholesaling down here in order to make quick money, right? Just like you can wholesale a rental, you can wholesale a seller finance deal or a subject to deal, but this is considering that you hold it, like you keep the property for yourself and hold it all the way through. So this would be how you acquire the property, is either the seller financed you into the deal, so you don't need money, right? You get financed into the deal, then you rent out the property, and then it looks a lot like a buy and hold, right? You have the same benefits that you do of a buy and hold, where you benefit from appreciation, constant dividend checks, which are your rental checks, right? And then depreciation on the asset as well. So that is seller financing. The next is new build holdings. This is more specifically for very big investors. So like, unless you got millions of dollars, that's probably not gonna be us yet. But what that looks like is a large plot of, maybe there's like a plot of land, they come in and they build an apartment complex, right, on it, or a mixed use complex on it, or even a commercial building. So they were the ones that built it, then they rent out and hold the asset, right? So it's more or less an expensive way to do a buy and hold, and you're only gonna really do that in markets where it makes more sense to buy, right? Where if you, let's say you purchased the land when the market was down, now the market's up, right? So you want to build when the market's up, lease out, you've got the most value out of your property, but you bought the land when it was low. That way, once your property is done, it was cheaper for you to build that property than if you had bought the same type of asset that was already built somewhere else. We don't have to worry about that one too much. That one's more like big time, more institutional purchasers and whatnot. Then we've got the next here is rent to own. So you would acquire the property, right? So you've got the property either through seller finance or you bought it, you put a mortgage on it, whatever. And then now you're selling it, right? So this is how you're moving the property. And a rent to own is two portions, right? So you've got the lease agreement that you're giving to a tenant. So you rent the property out to a tenant, but then you also give them an option to purchase the property, right? And so this is unique. You own the property, so you get the appreciation benefit, the depreciation benefit on the taxes, and you get the rental portion, right? Because they're going to be writing you rent checks each month. So you get all those benefits, but then since it's a rent to own, you get additional benefits that you don't get with a buy and hold, right? And so what those additional benefits look like are rent to owns, right? You give the tenant the option to purchase, right? After maybe, let's say 2 years. One, they have to put money up for that option consideration, right? So option consideration money can be $5,000 on maybe a $200,000 house. If they don't exercise their option within those 2 years, you keep that $5,000, right? Because it was consideration for the option. Additionally, if you're giving them the option to purchase, most of the time they'll treat the house like it's their own, so they'll handle a lot of the maintenance, and they will pay more than market price for the house. So if you give them the option, you tend to give them the option at maybe 120% of the current market value. So one, you make money on the option consideration, you make money on the rental checks, and then you make money when they actually exercise the option, you'll make money on the sale, right? So all of those are very good things. If they don't exercise the option, you're able to plug in a new rent-to-own tenant, collect another option deposit, and do it over again. So rent-to-own can be a great solution for a lot of investors, but again, we're not going to really. That's slower money. We're not really going to play into that until we've built up money of our own and we're able to purchase, and we want long-term assets. The next is vacation rentals. So it's not uncommon for a vacation rental to return, sometimes between 15 and 25% of the property's value through rental income. These are short-term rentals. They require more operational skill and management, right? You need cleaners. You need someone that's going to take care of the tenant there and whatnot. And so you've got some additional things here, but again, same benefits. You benefit from appreciation, rental income, and depreciation savings on your taxes. Cool. Then we've got reposition plays. These are nice and fun. These are for multifamily or bigger units. This is where, let's say, you come in, you see a property, it looks like a beat up, let's say 25 unit, right? So there's 25 units there, 25 doors, and it's totally beat to garbage, right? Tenants don't pay. Half the tenants are drug addicts or whatever, right? And the place is really run down. So you might come in and reposition that. What that means is you would likely come in, kick out all the tenants that are not paying, evict them, right? Get them out of there, and then start probably one by one renovating the units and then leasing them out for higher lease amounts than they were previously leased for. So once you do that to the whole building likely has new tenants. They're all paying more money. Then the property generates more income. All right, well, multifamily sells off of the cap rate. So cap rate is more or less rental income over the amount that you paid for the property. So this seems a little complicated, so if you don't get it all at once, it's okay. But basically, by repositioning the property, by putting better tenants in there paying more, you can now resell the property for more. So lots of investors will come in, they'll buy, reposition the property, sell in a year or 2 years later, but for 30% more than what they bought it for, and really can do very well that way. So even as wholesalers or co-wholesaling or micro flipping, we can sell to people. We can get a property in that needs to be repositioned, sell to an investor that's going to reposition it, and then they benefit and we benefit on the wholesale flip. Cool. Then we've got developments. All right, so developments come in all different shapes and sizes. This can be new home developments. Again, this is going to be more community, right? So they're building out a full community. If you've ever bought a new home, right, like a brand new home, you go when it's still a lot and they're building each lot, whatever, and you're like, I want this lot, I want my house to look like this, right? So those are gonna be more planned developments. Those can be not just residential, but also commercial. Those builders, generally these are bigger corporations that are doing those large spec'd out builds. And where we can participate, especially as individuals when we're starting, is by if we get a piece of property that we're like, wow, this would be a great planned community here, then we can wholesale that property, right, to a developer, a bigger development company. Then we've got new builds. So new builds can be spec builds, just one singular lot, right? This also can be referred to as infill projects. So if there's currently a little old property on the lot, right? Some investors might see more value scraping that property and building a new property on that same lot and then selling. So those are one-off builds, right? They come in, they do one build on one lot, that's it. So not big developments, whatever, but just one property. And really, these require capital. The turn times, depending on how big the property is, can be anywhere between 3 months to a year and a half to 2 years. Like if you're in Hollywood, just getting your permits is going to take that long. So like it can take forever. But new builds can be very cool, can be very lucrative. Again, you have exposure here. If the market drops while you're building the property, right after the market shifts, you can end up losing. Whereas at the same time, if the market continues to appreciate while you're building, you might end up making more money by the time it's done. But since there's so much lead time there between when you buy the property, you commit, you start building, and when you'll actually sell it, you inherit that risk, right? So you just want to make sure that's adjusted into the price that you buy at, right? So there's enough margin there, enough profit for you as the investor. And again, that's probably a little more for more experienced people, right? You'd probably want to do some fix and flips and a few other things before you went for a brand new build. Cool. Then we've got addition play. So this kind of plays off of new build, takes a little bit less time, right? So we're moving from slow to faster money, right? So whereas this might take a year, this might take 6 months, right? You still have to get permits. You still have to go through that process, but you're not tearing down the house that's currently there. You're just maybe adding a wing, right, to it. So you'll see this in some areas where if you were to just fix up the little house, maybe it's 1,500 square feet. If you just fixed it up, it would sell for 400, right? If you just did the fix and flip. But if you added maybe a 500 square foot or 700 square foot master bedroom, bathroom off the back of the property, right? Well, then all of a sudden that's going to sell for 650. And so if you're like, okay, well, what are my build costs? I can get that done for, I could get that done for 100 grand. Oh, well, I make more money on the deal if I do the addition, right? So those are called addition plays. Right? And again, that takes a little bit more skill because there's permitting, you need a good general contractor or really know what you're doing yourself. And so before we jump into those, we want to sit on this area, but you can make a good amount of money that way. And as wholesalers, right? As co-wholesalers or as micro flippers, we can sell properties to investors that will do that, right? And so we need to be able to see that. We need to be able to see the property and say, oh, that's what could be done there. That's what makes this a deal. That way we can sell it. We can recognize the opportunity, contract on it, and then sell it. Fix and flipping, this might be the only one that I don't have to, well, I think some people would understand quite a few of these, but fix and flipping, I feel like everyone does. Thank you, HDTV. But this is where we buy a property, right, that's beat up, we fix it up, we make it nice, and then we list it on the market and sell it at a premium price, right? And so benefits there, one, this is faster than an addition play or a new build. Most of the time it doesn't require a bunch of permits, right, which is really nice. Sometimes it can just be a lipstick job where you're going in, you're doing paint and carpet, takes you all of 3 weeks, right? If you've got a good crew, or sometimes shorter, everything's done. You relist on the market, you can get it sold, right? And then the qualifying, your retail buyer purchases or says they're going to buy, you contract, you go through your inspection period, and 35 days or 30 days later, you close on the property, you've made your money. The cons here, again, the market can adjust, right? Generally, when you're buying a fix and flip, you're buying at a reduced, like let's say the property is worth 200 grand, you're buying at, you bought at 125. Right? So if the market adjusts, you have margin there to meet that. You might not necessarily lose money when the market shifts, right? But you're not going to make as much as you would have as a flipper. But less exposure than a new build or a development, right? Where if the market shifts, you're really kind of stuck in a lot of ways. So same with, you still have the benefit, you can write off all of your expenses, right? What it costs to fix the property, all of the improvements and whatnot, and faster money than other options here. Now we move into my personal favorites, which are wholesaling, co-wholesaling, and micro flipping. Really, I think there are no negatives, so no cons. That might not be true, but these are where you're in the property and out of the property very quickly, so you have no market exposure. Maybe the only con here is that you don't get the depreciation benefit, right? Since you're never technically owning the property, you're contracting and then reselling for a fee, right? Or double closing and then netting out the proceeds between the A to B transaction and the B to C transaction. Which we'll probably explain later in another video if we haven't already. But you don't get since you're never technically owning it, you don't get the tax benefit. But these transactions can happen very quickly, right? So we've done properties where we've contracted on them one day, sold them the same day, and they closed the next day. And oftentimes you're making a sizable check. Our average wholesale fee is between $9,000 and $12,000 based on the month. And so it's a great way to very quickly make a lot of money, right? That also does not require a lot of money. Whereas buy and hold requires a lot of money and you're gonna make money over time, right? But builds to passive income. This is really more about making large sums of money very quickly. And ideally what you're doing here is you're building up those large, you're saving those large sums of money that you're making from this, and that allows you to pump back into some of these longer term appreciation strategies where you're receiving dividend checks that build passive income and passive wealth. So yes, I would say normally start here and then work our way back this direction. And personally, I'm fine if I skip over some of these pieces in the middle, right? that give us a little more exposure than maybe some of the other options. But yes, in short, those are the main different types of real estate investing. So now let's hop over to looking at kind of the Foursquare of real estate investment and then how we want to enter and exit our investment strategy to really set us up well as entrepreneurs and as real estate investors. The Foursquare of real estate investment basically takes, I would say, 4 indicators of what each of these little boxes could be, and especially the ones that investors just starting in real estate like to dive into first. So up here, we've got slow money where we need money. That's buy and hold, right? So if you want slow dollars, right, which would be passive income, it's not bad, slow dollars, and if you've got money, then you can consider buy and hold investment, right? And that works. Now, if you have money, right, but you want fast checks, right? You want to make money quicker, a quicker return on your investment. An example might be you might make 7% net annually on a buy and hold, right? But you could make 30% net on your money on a fix and flip in 3 months. Annualized, that's, I need to do math, 120%, right? So that's insane. Obviously, not every market's going to offer you a 30% net return on a fix and flip, but that's pretty dang good. So if you've got money and you want money fast, fix flip's an option. If you've got money and you want slow money that continues, like a slow drip over time with appreciation and a good store of wealth and depreciation benefits, then you can go with buy and hold. Cool. Now, if you don't have any money and you're like, I got $0, but you want to invest in real estate, right? This is where I started, having 0 money, and you want to invest in real estate, then you've got some options as well. So if you want slow money, if you want to create long-term wealth and passive income, you can start with creative financing, right? So you don't have money, but you're looking to build long-term passive income, boom, creative financing is where you're going to start. Now, if you're looking for fast money, right, you want to make checks quickly, build up a cash base, right? And then from there, jump into whatever section you want. Then if you don't have money and you want it fast, wholesale is really your best option, right? So now let's look at how I would advise you navigate, if you're a starting real estate investor, how you would navigate this, and honestly, how you would navigate it whether or not you have money. So I would suggest starting with wholesale, right? And the reason why I say this is some people, well, I've got a lot of money and I want slow passive income. That's great. If you start with wholesale, right, it's gonna be more work, right? A little bit more work to get things going, but this is gonna teach you value, right? There's lots of passive investors that buy terrible deals because they start here, but then they're stuck with that property, right? For a long time. That kind of blows. Whereas if you start with wholesale, you get a very good feel for the market, a very good understanding, good knowledge base. Then when you purchase a buy and hold, instead of making a 5% cap rate, right, you make a 15 or 16 because you knew what you were doing. And over the lifetime of that property, that's like an astronomical difference, right, between the two. So I suggest starting with wholesale. Requires no money, right, and results in fast cash, which is good, that's awesome place to start. From there, move into creative financing, right? Less risk, less money required, less leverage, but starts to build your long-term passive income flow, which is excellent. From there, we can jump to fix and flip when the market seems steady, strong, we like it, we're like, all right, let's go for this. That's a great way to, 1, support your wholesale business, right? So add credibility to your wholesale business. 1, make really awesome product that people can enjoy. But then again, like we talked about, some of those net returns can be very, very good, especially in certain markets. So moving into fix and flipping. And then finally, landing on buy and hold, right? Where we're really building passive income, we're building an asset base, and we don't ever plan to sell those. We plan to depreciate them and really hold them right through the rest of our life as we enjoy the passive income. So that's the way I would set it up. I would start wholesale, move to creative financing, then to fix and flip, and finally land on buy and hold. Cool, thanks guys. That's it for this video. Please like, subscribe, and comment any questions that you have. These are always a blast to make. Thank you guys for your feedback on them. And I look forward to seeing you guys in the next video that we put out next week.